Time to get started. Looking forward to going over a topic I actually haven't done before. It's a different type of topic, something that I think many of you will get value out of. It's something I've done a little bit for some of my conferences, little snippets of anyways, or little bits and pieces, and I'll show you guys some of the materials that I've created for that. But I wanted to talk a little bit about making decisions when it comes to real estate and whether you should be buying properties and adding more to your real estate portfolio, whether you should be selling properties and getting rid of them out of your portfolio, or maybe considering optimizing the property, which would typically be refinancing it or restructuring it in some way, shape, or form. So what I want to talk about to start and kick this off is that everything comes down to the return on investment. So whether you're looking at acquiring more properties, selling properties, or refinancing, the return on investment is the one thing that you can drill everything down to. That's the one thing that you can say, okay, how do I make a decision on whether I should be doing one of these three things on a moving forward basis? And the reason for that is that there's an opportunity cost. If you don't buy something or don't buy real estate and you have cash sitting in your bank account, you can either, invest in stocks, or you can buy consumer goods with it. You can do many different things with the cash. And ultimately, the return on investment is to say, what is the optimal way of deploying that cash? And this is where we're going to see that when you're selling and buying or restructuring properties, there's many different things that can come out of that. So the example I have here is just opportunity cost for those that don't understand or know the term. Something that's very used quite frequently in economics. But long story short, opportunity cost is basically if you were to deploy your capital in one spot or another, what is the cost if you deploy it here versus deploying it there? So in this example that I'm showing in front of me, this is showing that we have a business, it's got some available cash, and it's trying to figure out what should it be doing with that cash. And in one scenario, it can either upgrade its manufacturing plant, or it can invest in the stock market. And so in this example, it's suggesting that if it invested into its manufacturing plant and upgraded it, it would generate a $9,000 or 9% return on its capital in year one. Whereas if it just bought stocks, it would expect that it would make about 12% or $12,000 in the first year. So in this case, the company would say, well, I would choose option two because the opportunity cost, that difference is 3% between these two opportunities. So that would be a $3,000 amount. So let's dive into more specific examples and give you guys a better idea of what I'm talking about when I go into this. So let's assume that you're thinking about buying real estate. Obviously, there's many different factors going on in the real estate market, whether today is a good time or not to buy, or not a good time to buy. That's up for debate. I have done a previous webinar about some of the things to look at, in particular buying in a down market, what to look for in the opportunities. And so you can always find that on our YouTube display there if you wanted to look into that further. But if you're looking at buying real estate, long story short, you want to look at why invest in real estate. Most importantly is the leverage. That's the most important aspect of investing in real estate. And the reason for that is that when you buy real estate, you can put as low as 5% down for owner occupied and for second homes, and as low as 20% down for rental properties. Now, normally when you buy an investment of some sort, you're usually using all of the cash to buy the investment. Whereas in real estate, you're able to obtain a lot of leverage. And so if I'm going to give you an example of, let's say, what the leverage looks like if you buy a property for $500,000, and we assume that there's a 3% annual appreciation. Let's look at what happens when you buy a rental property first. And so if you buy a rental property and you can put 20% down, that means that you're putting 1/5 or $100,000 down on the property, 20%. Now, here's the return on investment calculation, though. And some people think, oh, well, if the appreciation is 3%, then my return from the appreciation is 3%. But you have to look at the return on investment, not on the asset value, but on the investment. So if you put $100,000 down and the property value goes up by 3%, so 3% on $500,000 is an extra $15,000. So if you've made $15,000 on your investment of $100,000, that means you've made a 15% return on your capital, not 3%. So effectively, you've leveraged your money 5 to 1. You put 20% down. And in this case, that means that for every 1% of appreciation, your return on investment is 5%. So using a 3% annual appreciation, which is typically what I use for most of my forward-looking real estate models, that means a return on investment of 15% from the appreciation factor itself. This is where things get kind of cool. As you look at a primary residence, you can put 5% down. So the same property for 500,000, now you only have to put a minimum of $25,000 down. So if that home appreciates by $15,000, your return on investment is actually 60%. Now, of course, this number can get pretty crazy and pretty whack if you look at it. It's not ideal to suggest and think that, oh, I'm going to get a crazy return by investing in real estate. But the reality is that the return from purchasing real estate and looking at the leverage aspect is frankly the primary reason that most people look at buying real estate. That's really where the bulk of the return is. So when you look at the returns, you're going to get returns from three different spots. The first is cash flow. That's what most people focus on. Now, in most major urban centers of Canada right now, the cash flow with 20% down is actually negative. And so a lot of people are trying to focus on, I want to buy a cash flow positive property. It's actually quite difficult to find properties that cash flow positive today. Most of the time, people are actually looking at a negative cash flow return with just 20% down. In particular, major urban centers like Vancouver and Toronto, really tough to find something that puts money in your jeans with 20% down, even if you're looking and seeking it out. Now, the appreciation part, we already talked about that. And if you assume a 3% annual appreciation, then you'd be getting a 15% return on your money, assuming that you put 20% down. Now, here's the one that people actually often forget about, and it's the mortgage paydown. It is not sexy. People don't really think about this, but when you look at it on that $400,000 mortgage, so if you put $100,000 down on the $500,000 place, the $400,000 mortgage, you're paying down about $5,500 to $7,000 a year in principal. Your tenant is paying that down for you, and so that is a return. Over time, over a long period of time, that mortgage eventually would be paid off, and so it's important to still factor that in. The reason that we have some ranges here on the mortgage paydown and cash flow, of course, it depends on where you're buying, what you're buying. And in the mortgage paydown part, it depends on what the interest rate is that you're getting at that particular moment in time too. But if you add up all these factors, the overall return on investment from buying real estate, if you assume a 3% annual appreciation, and by the way, if the appreciation is 0 1 year, look at what happens to that return. It's not nearly as good. But if you assume about on average a 3% annual appreciation, then the return on investment buying real estate is actually very good. It's 16.5 to 24%. And if you look at where that return on investment is broken down, if you're buying a property that has a small amount of positive cash flow, very little of the return is from that positive cash flow. A large chunk of it, about a third, is coming from the mortgage paydown, and close to 2/3 is actually coming from the appreciation, which is the bulk of the return. Now, going back to that thing that I mentioned earlier and looking at opportunity cost. Yes, the return on investment in investing in buying real estate seems good, but there's many different avenues and different things that you can invest in. So there's different options. And for example, if we look at this, buying a residential property for cash flow, maybe your return on investment is 15% or so. If you did a flip, or what's called a BRRRR, which is buy, renovate, rent, refinance, those can have higher returns if you're creating some additional value out of the renovations. But we have some more traditional items here too, which are stocks, private lending, what's called private equity. I won't go into a lot of details about what each of these investments are, but long story short, you have the opportunity, if you have cash or capital and you want to deploy it, you can either buy a rental property or you can invest in stocks. You could do private lending. You can do private equity. There's many different avenues and ways to look at this. So there is a quick question in the Q&A. How is the mortgage paydown of 5.5 to 7% calculated? It would be on the investment that you put into it. So it's basically how much of a $400,000 mortgage are you paying down each year? And the amount of principal generally range between about $5,500 to maybe up to $7,000 on a $400,000 mortgage. And so that, based off of your $100,000 investment, would be a 5.5 to 7% return. So that's the calculation on that. So when we look at the opportunities and the things to do and where to buy, what to buy, or not to buy real estate at all, and making that decision, you always want to look at the opportunity cost. And I will say that really since 2023, a lot of real estate investors have kind of pulled off, and for various and very good reasons. The real estate market has not performed nearly as well as it has been in the past. Values were still quite high at the time. Mortgage rates were still very high in 2023. Things have started to settle down, and I'm starting to see that sellers are willing to lower their prices to get things to move a little bit more, and that's spurring more opportunity, I would say, in investing in real estate. But overall, a lot of investors are starting to look at, well, where else could I invest? And for instance, the stock market has done very well in the last couple of years. It's hard, though. You can't look at what has happened to determine what will happen in the future. Some people are going to assume that the stock market is going to continue to rally, and some people are going to say, hey, because it has done so good, maybe it actually won't do as good moving forward. So you want to consider this, but ultimately what it's going to come down to is, what kind of return are you getting by buying real estate? And then what could you get if you invested it into something else? And nobody really knows exactly what you're going to earn on your returns. There are different asset classes that might be more certain, like investing in private lending. It's more certain because you're literally, if you are the private lender, you're writing a contract and saying, hey, I'm going to lend you the money, but I want 8% back on my money. Pretty obvious and pretty easy to determine what your investment return would be in that case. Stocks and buying real estate, much more difficult to know what your expected return would be. Now, we do have a residential cash flow analysis spreadsheet. Those of you that know me know I love my spreadsheets, but we have this spreadsheet built. And so if you did want to understand what is the expected return on this particular asset, then you can always run the numbers in this, and then it'll tell you, okay, this is the expected return that you could seek. So it will run your numbers on your cash flow and the cash on cash return, or return from the cash flow. It'll calculate what your mortgage balance would be over time, and then it also calculates the total return on investment with all of these factors rolled into one. So one of the examples I wanted to bring up, I had a conversation earlier this week with a client who was considering buying a rental property. It happened to be a property that was next door to them. And they're debating whether they should buy this property. And it was really tough to decide, okay, do I do it? Do we not? We're not really sure. At first, it seemed like a really good deal. And then there were some considerations. And one of the things that I wanted to look at is, what would you need to do, or how would you evaluate a property like that to see if it's a good buy? And so what I looked at is, and this is not an exact example of the details, but what I did to run the numbers and look at it is I said, well, what if, so they thought that maybe they're getting a $100,000 discount on the property value, and maybe that's true, maybe that's not. Without an appraisal, you wouldn't know if you're actually getting a deal on it. But in theory, even if the property was cash flow negative, and that would put you in a worse position financially, the question is, well, is it still better if you wanted to invest into something? Is it better to invest in that property or not? And so what I did, I used the spreadsheet and I just reverse engineered the appreciation rate on it, so that using 3% versus using a higher appreciation rate, that the future value would be about 50 grand higher. So I'm assuming, let's just say that I buy the property at a lower price point, but it appreciates the same total amount over a 10-year period. So in this case, it's appreciating about $50,000 more because I got it for $50,000 less when I bought it. And it did bump up the return on investment in total. So in this case, if I go back, the return on investment was 13%. But if I get this property at a deal and buy for 50 grand less, my return on investment jumps up to 18%. And that becomes a lot more attractive enough to maybe say, let's buy this property. Hard to say. But I do find in this type of climate, in this market, we're finding that more people are having that analysis of like, should I buy this property? I'm not sure. I think I'm getting a deal on it, but it's still cash flow negative, or I'm not sure if the timing's right or whatnot. One of the things to look at then is, okay, can you reverse engineer what your expected return would be if you maybe just say, well, what would the normal 3% appreciation be? But what if I got it at a discount of 50 to 100 grand and then assume that then I'm going to get more appreciation on this property? How does that affect my return on investment in the future? And in this case, it bumped it up by 5% overall return on investment, which is quite significant. There's a question, the average expected return for private lending in today's market. So it actually varies quite a bit depending on whether it's a first mortgage, second mortgage, et cetera. But first mortgages generally are between, most of them, 7 to 9% interest. Second mortgages generally between 9 to 12 or 13% interest would be a typical second mortgage rate. Obviously, there are extremes. We've done some first mortgages that lower than 7% and some that are higher. We've done some second mortgages that are way higher than 15% in some cases for more extreme scenarios. But it generally, first mortgages between 7 and 9, second mortgages between 9 and 12. I'd say that the bulk of lending would fall into. So I want to go through another scenario. This is one that's been coming up a lot too. So in a slow market to sell, a lot of people are thinking, well, if possible, could I keep my existing home and not have to sell that to then buy something new moving forward? And so there's a lot of conversations that we're having regarding that. And here's a simple example here. So let's say that we have a $500,000 property. It's got a $200,000 mortgage on it. If it was rented as a rental property, it would generate $2,300 a month in rent. And if we refinance it and bumped up the mortgage, because we still need the down payment from the existing property, so we're going to bump up the mortgage from $200,000 to $400,000, and that's how we're going to take out our down payment for a $1 million purchase. Now, in this case, I've estimated that the property would now be negative $150 a month to keep it, and that's because I've estimated that the strata fees, property taxes, etc., would be about $500 a month in total between strata and property taxes. So the property's going to be a net negative to keep, okay? So the question is, should you keep it or not? So let's kind of run through the math on this on each side. If you sell the property, then you don't have any payments on it. And after realtor fees of probably about 25 grand to sell, you would net out after paying off the mortgage if you're selling the property at a discount, right? This is the biggest key, is that you think your place is worth 500, but in order to sell it today, your realtor's like, it's pretty tough. You're gonna have to blow it out at 450. So that's the big question here: is do you sell it at a loss today, or do you hold it? In this case, the realtor would suggest, well, after realtor fees, you probably get about $225,000 if you sold the property. So okay, so now we know that if you sold it, you wouldn't have any negative cash flow on holding it, and you would have a $225,000 down payment. Now, if you kept the property with the property tax, strata fees, et cetera, you're negative $150 a month. You would have no realtor fees to sell it in this case, but you'd only have about $200,000 towards your down payment now, because refinancing it only gets you a mortgage of $400,000. Now, one of the things I have assumed here, and this may or may not be the correct assumption, by the way, in many cases in this scenario, if you have to fire sale it, let's say that you found the perfect home, but the seller wants to sell or sell it to you in 30 or 60 days, your realtor might say, if you want to sell your current place in that time frame, you have to blow this out, like get rid of it, sell it really, and be really aggressive on price. And that's where that 50 grand cut comes from. That doesn't mean necessarily that it would appraise for less. It, of course, could appraise for 450. I've assumed that it may still appraise for 500,000 if you're not under duress to sell it and sell it really quickly. And that's how we get a $400,000 mortgage. So if you look at comparing the two side by side, if you're keeping it, you're only getting $200,000 for your down payment. If you sell, you get $225,000. So you actually still get more money available to you if you sell it. Now I factor that in, that now if you put 25 grand less down payment on the new purchase, your mortgage is $122 more per month. So your total cost is a negative $150 a month to keep the property, and then an extra $122 more in your current home. So that's $272 a month. Now, for those of you that are prudent and looking at this and maybe own real estate, you might be like, how about the property management, et cetera? So I'm simplifying this to say you could include property management. There's many different things, but I want to show you the things to break down and look at, like what are the numbers and what's the decision-making methodology here. Now, interestingly, in this case, if you are negative $272 a month, and if you were trying to figure out a break-even point, I like to use break-even points wherever I can, because I think break-even points makes it easier to make a decision. If you can afford the $272 a month loss, you could hold the property for 183 months, which is about 15 years, to wait until the property value has recouped and brought itself back up to the $500,000 valuation. That's a really long time to be able to hold a property and wait for an opportune time to sell it in this case. Now, not in every case does the math work out that way where it's 15 years for the break-even point. In fact, many of the ones that I've done and gone through and walked through clients on this, it's actually been much less than 15 years. In many cases, it's closer to 5 to maybe 10 years. But the interesting thing is that many people, especially for the condo market, believe that the condo market may recover starting in like 2029, 2030 as less new product is getting built and started today, which won't be finishing in the near future. And eventually we go from having a oversupply to being undersupplied again. And that would put upward pressure on values. And so the question is, should you keep your existing property or sell it in order to upgrade and buy yourself a new residence? And this is the conversation and the math that we're looking at. Now, one thing that we haven't included in this, because I don't want to put too many numbers on this, but you're also paying down principal on the mortgage as well. There may be tax implications with holding this. So there's other things to consider. But we've done this calculation for a number of clients. And this is a simplistic way of looking at how long could I keep the property before the property value eventually comes back up to what I think it is worth if I don't have to fire sale it and dump it in a soft market. We can also do the same analysis we have for a lot of clients in a different scenario, though, which is in particular in pre-sales. So a lot of our investor clients made decisions to buy pre-sales 3-4 years ago. They're completing now. And the decision is, do I keep this and just rent it out and hold it for a period of time? And maybe it's 3 or 4 years or 5 years, wait until the market's better. Or do I just get rid of it, cut my losses now? And this is where you have to run the numbers. And sometimes, in some cases, I'm finding that the pre-sale valuation is coming in lower. In fact, I would say more times than not, the value of a pre-sale completing now is lower than what it was initially when you wrote that offer. So there's there's going to be a bit of a hit on the property value right away. And so if you just closed and then just sold it right away, then what would be the loss that you would take on that? And then you compare to, well, how long could I hold the property and maybe recoup that loss? If the cost is let's say $50,000 is what you think you're going to lose if you sell it right away, but the cash flow would be negative $1,000 a month to hold it, then you could look at say, well, okay, I'm going to be negative $1,000 a month. I could hold it for 50 months and then recoup all of it. Now, technically, you actually should be capturing and thinking about the mortgage pay down as well, because not just the cash flow being negative, but you're be offsetting that negative cash flow from a tenant paying down your mortgage for you, which should always be part of these calculations. Because then if you sold it immediately after getting a mortgage versus selling it in 4 years after a tenant's been paying down your mortgage for you, well, you're actually going to have even more equity to capture when you sell it in the future. So there's a question here: can this calculation method be shared with us in some way? So there's a couple different ways that we're going to walk through it. I do actually have a document that I'll be able to share with everybody at the end of this. And it's going to be coming up actually when I start to talk about the refinance calculations. It's a more simplistic way of being able to write out the information and you can visualize it. Some people like to use Excel for this kind of stuff. Some people like to use like pen and paper. And so that you're going to actually have access to both. But this is the way to do this analysis. You'd run a mortgage calculator or run it through the spreadsheet, see, okay, how much principal would I pay down over that period of time? How negative would I be over that period of time? And then you can kind of reverse engineer, okay, well, how many months could I hold it for before I recoup it? And you basically just take the loss that you're having of $50,000 and you stretch that over. You basically look at what the monthly loss is and how long it would take before you could recoup that $50,000. There's a question about taking into account the capital gains tax during the sales situation. Well, here's the interesting thing. Depending on how you own the property, many of you may be looking at owning the property personally. some of you may be owning in a company. There are capital gains considerations here, depending on whether it's a primary residence you're selling or not a primary residence that you're selling. And so these are other considerations you need to take into account. In many cases, you may not have a lot of advantages to having a negative capital gain, so to speak, if you sell the property at a loss, unless it's owned in a company in particular, may be allowed and able to offset future gains. But in general, it's a bit harder to actually have an advantage just selling it and then having a loss on paper from a capital gains perspective. But if you wait and then have any appreciation over and above, then you would have capital gains. Now, in this case, if you're buying a pre-sale and you paid $500 for it and it's currently worth $450, it could appreciate all the way back up to the $500,000 mark without triggering any capital gains, which would be nice because your $500,000 purchase price, eventually you're just getting back to square one effectively. The nice thing about that is that then you wouldn't likely have taxes. Obviously, you always have to talk to an accountant to verify any of the tax information that we talk about today, but my understanding is there would be no taxes. Not on the capital gains anyways. So talking about a primary residence or an existing property and looking at optimizing an asset, this can go for your primary residence, which we've done a number of different webinars about utilizing the home equity in your home as using either the Smith maneuver or more basic options here. But effectively, if you have your home paid off for you or it's largely paid off, having your home with a ton of equity in it isn't really working for you. And there are methods where you could access that home equity to then invest and purchase other investments. And basically the way you want to look at doing this in many cases is, can you borrow the money at a lower rate than what the investment return is going to be? That's the most simplistic way of looking at, should I borrow money out of my home to invest? There are other advantages to being able to do that as well, because borrowing to invest means that you're able to, in general, write off the interest portion of the payments to do so as well. But there's a lot of things to unpack there. But what I really wanted to focus on, because I've talked about that a number of times in the past, and again, lots of webinars on that, I wanted to focus a bit more on you reviewing and analyzing a property in your existing portfolio already to see, does it make sense to refinance? And the math is very interesting on this. And I think for a lot of people, it's surprising and shocking that going in and optimizing an existing property could have this kind of benefit. So let's walk through this and just go line by line. Okay, so you've got a property, just picked a random property address and picked a random value of $800,000. And then I said, let's assume that the current mortgage is $300,000, and we're going to refinance it and bring it up to 80% financing. So our optimization, we're going to refinance and pull out $340,000 out of this home. So our equity is going to go from $500,000 down to $160,000 because we're going to take a whole bunch of cash out. Now, at this moment, the rental income is the same. Doesn't matter whether you're it's the current or the optimized version. You're not restructuring your tenant. You're restructuring your financing and your debt on it. Now, what I find is many people have a situation where they actually have mortgage payments because they've been paying off their mortgage for, let's say, 10 years, and maybe you have 20 years left on your amortization, or 15 years, and now your mortgage payments are actually quite high. You're actually not generating a lot of surplus cash flow. You are paying down a lot of mortgage a lot of debt on the principal, which is great, because you're paying off the mortgage more aggressively. But from a tax strategy, it's actually not the greatest idea, usually, to pay off a rental property mortgage in particular that aggressively, because you write off the interest portion of the payments. So if you have less interest to write off, then that means that you're going to have a higher taxable income every year. And now if we look at the other monthly property expenses, those are going to be static, about $650 a month for either scenario. But in the current scenario, this property would cash flow positive $1,200 a year, so $100 a month. With the optimized version, you're actually be negative cash flow. So you're going to be negative $10,356 a year. So you're almost negative $1,000 a month to borrow all that money out of the property. So you might be wondering, well, is that really optimizing it then? Like, why would I do that? But let's take another step here. Here's the interesting thing. You had a $300,000 mortgage that that was an aggressive amortization. You're paying it off really fast, and it feels good. You're paying it down at a rate of $11,733 per year. Now, interestingly, now you're going to take out an extra $340,000 and then stretch the amortization back out to 30 years. But now you're actually paying almost the same amount of principal down every single year. Now, in addition to that, we look at the appreciation. That's still 3%. And regardless of the value of the property, the amount that you get per year in appreciation amount is $24,000 because it's 3% of the $800,000 value. But what happens is everything's going to be pointing back to one specific number and then recalculating all of these figures out now. So when I look at the cash on equity, so if I look at the equity that you have locked into the property, everything for the current example is going to be based off of $500,000. So I'm taking $1,200 a year cash flow per year, dividing it by the $500,000 of equity, and my return on cash flow is only 0.24%. So it's not very good. My return on my mortgage paydown, even though I paid down more money on the mortgage, I have $500,000 locked into the property to pay down the mortgage by $11,000 every year. I'm only getting a 2.35% return on my capital if I have $500,000 in the property, generating an $11,733 return from the mortgage paydown. And then the appreciation part, if I assume a 3% annual appreciation, that's $24,000. If I make $24,000 on my $500,000 investment in the property, then I'm only making a 4.8% return. So currently, this property, because it's not optimized, it's only generating about a 7.4% return on your money. So what ends up happening is the longer that you own real estate, the longer that you're in a position where your return on your equity actually starts to diminish over time. And you could be potentially refinancing, pulling money out to then optimize it. So in the optimized approach, you're actually taking out this money, and now your cash on cash return from your equity is negative. So that is worse. It's gone from 0.24% to negative 6.5%. But now your pay down on equity is actually better. So even though you're paying down a little bit less, it's because you're paying down almost the same amount in principal on your $160,000 that you're leaving in the investment. And then you look at now the appreciation component. Now, if you make $24,000 of appreciation on a $160,000 investment, the amount of money that's stuck in the property, your return is 15%. So now we've bumped up this total return on equity from 7.4% up to 15.35%. We've made a huge, significant move up. And what we can also look at here is what we really did is we took $340,000 out of the property. And yes, we moved and we basically put ourselves, in order to take out that much cash, we moved our cash flow in a negative direction. It's now $11,556 a year worse than the initial situation. But if you were to take that $340,000 and then invest it, and earlier we talked about maybe investing in private lending or something like that, you could actually take the $340,000 and invest it into being a private lender at a conservative 8% return. You would generate $27,000 a year on that return, which would more than offset the negative $11,000 return that you're getting by borrowing all that extra money out. So you're actually ahead by almost $16,000 in this case. So at the end of the day, the reason I wanted to show you what you could do with the money, because ultimately you only generate a positive return if you actually did something with the money. You wouldn't necessarily do all of this and say, okay, well, now I'm paying down. If you didn't do anything with the $340,000, you're now getting less cash flow. It's almost $1,000 negative instead of being $100 a month positive. You're paying down a little bit less on the mortgage, and your appreciation in total is still just $24,000. That's the amount you'd be in theory getting. But if you did something with the $340,000 and invested into something else that can now earn a return, now all of a sudden that's where you're starting to really generate and move forward. And in this case, just by a simple restructuring, you still have the same amount of cash stuck in total in your investments elsewhere. Your equity has now gone from $500,000 in a property to being $160,000 in a property, and then $340,000 in private lending or whatever you want to do with the money. It's still $500,000. And now you are in a position where your cash flow has actually improved significantly. And now you're actually in a spot where you're positive $16,000 of cash flow per year instead of positive 1,200. So there's a question here, which is, do you still need to pay interest on the borrowed 340,000? And yes, you are, and that is included in this. And so the mortgage payments of $3,113 a month is with you borrowing $640,000 over a 30-year amortization on the mortgage. And so we are paying that payment, and we have interest costs that are included in that. But on the flip side, we now have $340,000 that can generate a return elsewhere. And this goes back to the thing I was mentioning earlier, which is, do you borrow to invest? If one of the reasons that this particular example works and makes sense is that we're using current mortgage rates that are in the low to mid fours right now to borrow against this property. And then if we took all of that cash and then put it into an investment that generated 8%, we're getting a spread. And that difference of nearly 4% on that $340,000 is generating over $12,000 in surplus value for us, just by getting a spread between the cost of that $340,000, that 4 to 4.5% interest, versus earning 8% interest somewhere else. And then you have taxation on both sides, because you're now writing off more interest on the mortgage itself, but you're also going to have investment gains, and then it depends on what the investment return is. If it's dividends, or if it's interest income, or if it's capital gains income, those all get treated differently, and I won't get too deep into the weeds on the tax component of it. But you're getting, it's both, the amount is on both sides of the equation. So I see, Moo, you've raised your hand. Do you want to maybe put your question into the Q&A? I'd be more than happy to answer it for you. I know there's a lot to unpack with this, and it can be a bit surprising when you run through the numbers and kind of look at it, but it's very, very interesting and very cool to look at. So yeah, if anybody has any questions, put it into the Q&A. I'm also going to have at the very end, I'll allow more time for Q&A. I'll answer more questions as well. So I wanted to go over a little bit of an update just on the mortgage rates. Of course, everybody's kind of wondering what's going on there too. And so I wanted to walk through that a little bit just to wrap up the presentation and then get into the Q&A. But Bank of Canada, again, paused. The crystal ball for us is telling us that for fixed rates in the short term, unclear, but there is currently some upward pressure that we're feeling at the moment. Medium term, almost all economists are predicting that rates will be a bit higher. Long term, same thing. So unfortunately, when you add up tariffs and the oil crisis with the war in Iran and everything, this is all inflationary. And as we saw back in COVID, it can take some time, a couple of years, for the inflation to kind of work through the system and then erupt. And it can also take years for inflation to come down too. So in this circumstance, most economists are predicting that rates will be higher in the future, and not by an insignificant margin. This pendulum swings all the time, but 30 days ago, they were expecting that within 12 months from now, that rates would be up to, maybe 4.91%. If I look at today, those same people are predicting that the rates will be up to 5.1% in 12 months. And so the curve is shifted upwards, and there's a higher expectation of higher rates in the future to consider when you're looking at like what kind of term and rate should you be looking at taking. If I look at our lock-in meter, it's somewhere around a 7 out of 10, meaning that you're not sure if you want to lock in or not. Obviously, this is a very personal decision and conversation, but it is suggesting that if you're conservative or you're worried about interest rates rising, you may want to look at locking in potentially. Now, I know I talked a lot about a lot of complicated topics and things, but if you did want to book a consult with myself or Tim on my team, and we'll be putting out an announcement shortly that I did bring in a partner into Green Mortgage. His name is Tim, and he's literally like a younger Kyle, so you guys will love him. Also a spreadsheet nerd too. But I'll be more than happy to go into some more details, and we will send out some materials. So I should be able to send out the cash flow analysis spreadsheet as well as that PDF that I was kind of walking you through on all of the optimization. So you can actually do that with your current portfolio. You can kind of do it manually if that's the way that you want to do it. You can see, oh, actually, yeah, I should improve this. I should refinance to optimize it, take out some equity, and do something else with it. So reach out if you would like to get copies of those documents, or if you'd like to actually look at your portfolio and see, okay, is there anything that could be optimized? It may also be a good time to be looking at optimization, because if rates are intending on rising, refinancing when you're kind of in that low point, it may be a better time to do that, as opposed to waiting 12 or 24 months and then seeing that the rates are higher. For those of you that don't know, I do have a book called Rockstar Real Estate Investing. We'd be happy to put a copy of that book in the mail. If you want to send us over your mailing address, then we can put a copy in the mail for you. And other than that, I'll open it up for questions in the Q&A. So just go into Q&A and then type out any questions you have. I'd be more than happy to answer them. No questions yet? You guys are all good? I know that Moo, you raised your hand. I didn't know if you had a specific question that you wanted to ask. Yeah, so the suggested strategy works well in growth phase and not in consolidation phase. Yes, and here's the reality of it. When you look at it, if most of the return on investment is coming from appreciation, then you need appreciation to get the return. And so absolutely, if values are going down and you have a lot of leverage, that will work against you, because you're not going to get as much, if any, return from cash flow, less from the I guess your mortgage paydown would remain the same in that scenario, but then you wouldn't have any return from appreciation. So that's where you win really well when the market does turn. But if the market is worsening, leverage is going to work against you for sure. So that's something that you need to be considering. That's where some people, I'm finding, we're doing more of this. So back years ago, we used to do a lot of refinance to then buy another property. We were doing a lot more refinance to then put money into stocks or put money into a different type of investment class and maybe balance things out. A lot of our clients have been very heavy in real estate for quite some time and are thinking maybe you should spread things out a little bit more than before. But yeah, you have to assume that there's if you're going to be borrowing to invest and buying more residential or commercial properties, then you need the real estate valuations to go up to be in the money. Question from Annette: why is to combine two mortgages into one? It kind of depends on the terms you have and the rates that you have. In some cases, it makes sense to pay penalties on one of the terms or both of the terms to then roll them into one. One of the benefits sometimes of having multiple terms is that then you have different terms. One of them, maybe you go variable on one and one you go fixed, and then you kind of have your foot in both sides. I was talking to another colleague of mine at a lender lunch today, and he said he's been putting some of his clients into spots where they do a third 3-year fixed, a third 5-year fixed, and a third variable, because who the hell knows where rates are going, right? That was his perspective, and he's doing that for a few of his clients. The thing I don't like is that then all your terms, if you're choosing different length of times, your terms don't line up. So your 3-year term is going to come up for renewal in 3 years, but then you're still in term on your 5-year terms. And then, okay, well, maybe the current lender's not offering you a competitive rate to renew that one portion. Well, now you have to break your existing mortgages and pay penalties on the other ones if you wanted to move it. So I do like it generally when the terms are matching, or in some cases to just combine the terms into one mortgage. But the benefit of having multiple terms is then you can kind of hedge a little bit. So advice for a young person wanting to get into real estate. I would say that in general, the first spot to look is usually your primary residence. That's usually the one that makes you the most money. We used the example earlier of buying a residence with 5% down. Your return on investment is higher for that. In addition to that, there are no capital gains taxes on your primary residence appreciation, but you would have that if you bought a rental property. I find that most people make more money on their home than they do on their rental properties. Number one, and then number two, you generally have to pay to live somewhere anyways. And so usually people end up buying their own home and owning that. That's usually a good start if you can afford it. I know in some cases, some of these people will stay living at home and then buy a rental property or two, but it can take just as long to save up for the down payment, to save up, live at home, and then save up the 20% down to then buy a rental, as it can to just live at home until you can save up the 5% down and then go buy a primary residence. So sometimes it's actually not shaving off a lot of time to get yourself into real estate. Can a standard mortgage become a readvanceable mortgage? It can be. You just have to restructure it. Some lenders, it's easier to restructure it more of an internal basis where they just change the product. Some lenders, it's a full refinance. So it actually depends quite a bit. It is harder to qualify for a readvanceable mortgage. Often the play usually is when you have your term or one of the terms come up for renewal. That's usually a good time to say, hey, let's reevaluate. Can it qualify for a different product now? And there are various products that could be a good fit for that. Some lenders that allow for more flexible debt servicing, so you can qualify for more money with certain lenders. So there's different ways of doing that. So what about properties that are part of a rental pool? This is a good question. We actually were dealing with one in our office today. So there is a property in Whistler that is inside of a rental pool. However, one of the key things that we're usually looking at to try to get a lender on board is, does it allow for unlimited owner use? If it restricts owner use, it's much harder to get financing on it. Also, the other component is that if you must be part of the rental pool or if you can rent it out yourself. So there's actually a few different things that we will look at. Some lenders will just say, we do not lend on this property at all. Some lenders will say, you know what, for hotel condos, we'll go up to a maximum of 65% of the value, so they won't go up to 80 or above. So every lender is a bit different. I will say these are very case by case. And so if you have a property in mind, you can send it over to us and we can investigate to see what kind of financing options might be available for that particular property. Because we usually have to read through the bylaws and go through quite a few steps to see if it's doable. Any city in Greater Vancouver and product type you would recommend right now for investment properties? Good question. So on one hand, condos are not doing very well, and I still think there might be some more downward movement on condos. But there's also going to be a certain number of people that are very motivated to sell. And so my thought is that if the market is going down, but at some point it's going to hit a bottom point, if you can find somebody that's willing to sell it for below that bottom point, then you may still have a deal for yourself. But it's hard to say exactly. In Greater Vancouver, the issue is that detached properties just generally don't. I think that their prospect for appreciation is stronger, but they just don't cash flow as well in general. I think that what you'd probably be wanting to do, if I was to pick an area or pick a spot that I would want to invest, I'd probably be trying to find detached property that is 2, 3, or 4 units. And you're probably then having to go further out to do that. You probably can't make the numbers work in like actual Vancouver. So you're probably looking at Surrey, Langley, Abbotsford, Mission, maybe Maple Ridge, and perhaps Chilliwack. Chilliwack's an interesting market because it actually, the values went up quite a bit during COVID, and there has been a bit of a settling down now. And so you might actually find that there might be some deals in Chilliwack. I haven't personally looked in Chilliwack myself in quite some time, but my intuition is telling me that maybe that would be an area to look at. Depends on your price point as well, of course, too. But I'd probably be looking at Surrey and Maple Ridge and East, and looking at detached if I can afford it and qualify, 2, 3, or 4 units. It's probably be my take. Is the Manulife One a good product for the Smith maneuver? So we get this question asked quite a bit. The primary reason that the Manulife One is a good product for the Smith maneuver is it allows for a lot of accounts, more than anybody here is probably ever going to need. But you can get up to 99 different accounts if you want to, which makes it really easy to separate sub accounts and do, $20,000 invested here, $50,000 invested there, and each of those could be their own sub accounts, which is really useful. One of the other key features is that you can use the line of credit and provide a void check or a pre-authorized debit. So you can actually have payments come right out of the account, whereas for most banks, their line of credit, you have to move money from the line of credit into a checking account, and then payments can come out of that. Now, it is one extra step, which sometimes makes it a bit more, it's a bit more onerous for people to utilize it in that way. For people that are doing what's called cash damming, it's one extra step. That being said, for a lot of clients, they also look at it and say, well, I'm sitting in front of the computer moving all the money around. There's quite a few steps that you have to do every month anyways if you're cash damming. And so one extra step is not that big of a deal. So it kind of depends on the scenario. And ultimately, if all things are equal, if the rate is the same and everything else is the same, then yeah, I'd probably recommend the Manulife. And then is Manulife's interest rates always the best? Some things are very competitive, some things are not. So I think that needs to be a component too. So we generally will look at and say, well, what is the interest rate that you're getting on the Manulife One product? And what's the ease of use and what are you going to use it for versus a standard mortgage? A couple other components, however, that people sometimes utilize this for is the Manulife One does not need you to make a payment. So some people use it like a reverse mortgage, where we call it a pre-reverse in some cases. Maybe you eventually are going to go into a reverse mortgage. Right now you owe $200,000, but maybe we can get you an approval for a $500,000 limit. You can actually never make a payment on it until the balance reaches that $500,000 approved limit, which is really useful. And then for those of you that are maybe in retirement age, there's also an important point, which is that they have right of survivorship, which means that if one of you were to, heaven forbid, pass away, the remaining person does not need to re-qualify for the mortgage, which can be really stressful if you have two people, one of them passes away, then the mortgage renewal comes up and the bank says, hey, we need you to both to sign the renewal. They're like, oh, actually, I'm the only one left. The bank says, well, I don't know if you qualify for that mortgage. And all of a sudden, you might have to sell the home or might have to move your mortgage to a higher interest lender or something like that. Would not be fun. So the right of survivorship is a really important feature of the Manulife One product too. But for certain people, of course, it's more important for those that have spouses and are maybe retired, and that's more on their mind versus somebody that might be younger or single. Question is, I own and live in a one-bedroom condo in Vancouver that's fully paid off. I would like to move into a larger space, but keep my condo as an investment property. It's paid off and worth $600,000. I'd like to use my condo as leverage. How much can I borrow and what options do I have available? So this is going to be based off of your income to a certain extent. However, if you qualify, you could go up to 80% of the value of the condo, so up to $480,000 on the condo. Take that out, and that can be your down payment on a new purchase. Now, interestingly, due to the way that lenders look at the rental income, sometimes it actually makes sense to put more debt on a property that's going to become a rental property, and that's because if the rental property income is high enough and the offset or rental offset method the lender uses, if there's enough rental income to offset the expenses associated with that property, sometimes it's actually better to put more debt against it. Because if there isn't any debt secured to it, they take that rental income and they water it down. And so effectively, in some cases, we can actually borrow overall more debt if more of it's on the rental and then less is on the new purchase on the other, when you make that arrangement. Probably something you would have to actually dive into some numbers and math and everything. But if you did want to dive into that further, we need to know more information about income and any other debts and what kind of purchase price range. Are you buying some of the basement suite? What kind of rental income the current property would rent out for? Those are all relevant details that we'd have to dive into. Jason's asking what sort of HELOC rates are we looking at right now? So generally, most lenders are prime plus a half, and then there's a few lenders that will offer lower interest rates. We were on very few cases here getting prime plus zero if the borrower was borrowing a lot of money on the line of credit at completion. That is possible. I have been finding there's been more pushback in the last like 30 or 45 days on that, so it's getting a little bit harder. Most of the time, then I'm recommending that prime plus a half is like most lenders will offer that. A certain number of lenders can get you down to like prime plus a quarter or so. And then in some cases, maybe prime plus zero, but it's a bit tougher. But that's what we're looking at for a line of credit rate right now. Lots of questions regarding private lending. When's the webinar? Thank you. So the private lending webinar, we haven't announced that yet. We do it every year though. It usually is in the fall. Probably will be either October or November. We also have previous webinars we've done on private lending. We could learn more about that too, William. So just feel free to check there or wait for our next one that comes out, and it'll probably be in the fall. Jason's asking, lately, have you come across many appraisals that are below market and hence result in lower financing amount by the bank? Absolutely, and almost exclusively on pre-sales. Not to say that's not happening on regular purchases as well, but it's definitely happening on pre-sales quite a bit. And so we're preparing a lot of our clients that are completing on a pre-sale that, by the way, you might be in a position where you will not be able to get 80% financing of the purchase price because the appraisal will be low. So let me give you an example. If you're buying a property for $500,000 and you were hoping, let's say that it appraises for $450,000, you were probably hoping for a $400,000 mortgage, which means that you're basically just putting the 20% down, the $100,000. But if the property value is only $450,000 instead, then the max loan goes down from $400,000 down to $360,000. So effectively, your down payment goes up from $100,000 to $140,000. It goes up by 80% of the difference in the value, basically, because you're no longer getting 80% of that amount. And this can be very stressful and difficult for a lot of borrowers. There are some solutions we have. In some cases, people will refinance other property to make it work. In some cases, there are different ways that we can arrange it. We've had some clients put less than 20% down. Now, if it's owner occupied or a second home, then you can buy with less than 20% down. That's a way of maybe mitigating it. So there's lots of different ways that we can solve that, but it's not easy. Is there a minimum amount you would need available for private equity lending? So this is a question I'm not certain if you're wanting to be a borrower or a lender, so I'll just answer both. But if you're wanting to be an investor and lend on property, if you're wanting to do first mortgages, then usually you need at least $500,000 to really have a lot of lead flow or options in Vancouver. Because if you wanted first mortgages, well, mortgages here in Vancouver and Greater Vancouver are quite large, and so you probably need a larger amount of capital to do that. If you're wanting to do second mortgages, then you can probably go as low as about $100,000, but most of them you need closer to $200,000 or $250,000. I would say that the smaller ones, on average, for second mortgages are more in the $200,000 to $250,000 range. If your question is, I want to borrow money, what's the minimum I need in order to be able to qualify for a private loan? Then generally your down payment needs to be at least 25% down, but ideally closer to 30 or 35% down. It depends on what you're buying, where you're buying, etc. As an example, if you're buying bare land in a small town, you probably need 50% down, and even that might be difficult to find a lender that will do that. So the down payment will vary depending on what you're buying and where you're buying. Another question, are there bridge solutions? Would you recommend, since the buyer would be buying into a loss? Yeah, this is an interesting question that kind of goes back to that earlier thought experiment of, if you're closing on a pre-sale and the value is coming in low, do I hold it and be cash flow negative on it for a period of time and then wait until the market recovers and then sell it in 3 to 5 years? And that would be a reasonable expectation that maybe the market's better in 3 to 5 years. I would advise somebody that, hey, just hold it for a year or two and it's going to be great by then. I think this might last longer than we're all hoping or expecting. So it's good to go in prepared for that. And there are bridge options, but you would have to have equity in another property. We've had a few people get help from parents who then jump in. And as an example, If parents have equity in real estate, then you could tag that other property and use it as additional collateral, and then you don't have to put more cash into the deal to close on it. You could put less than 20% down. That's another way of not having to put more cash into the deal to close if you can qualify. Or refinance other properties that you own is another way of qualifying. So there are different bridge options. If the borrower is a situation where it's not the cash that's the problem, it's the qualifications that's the problem, then there are bridge lenders like private lenders that will do that type of loan too. It's just that they're more expensive, and then the cost to holding it is so much higher that instead of being negative $1,000 a month, maybe it's negative $2,000 a month. And then it's like, well, can that person actually afford a $2,000 a month negative every single month? Maybe you're better to just cut your losses and just sell the property immediately. One thing I want to note, because we've had a lot of these conversations lately, if you have a pre-sale and you're trying not to close on it, note that it's not just your deposit that you could be walking away from. You have legal liability where if the developer sells it for less than you're supposed to buy it, they may have losses that are larger than the amount that you gave up as your deposit. So it's not just the deposit you may be walking away from. And you always recommend somebody get legal advice before they walk away from a deposit on a pre-sale. If we invest into private lending deals, do you screen the borrowers first, complete due diligence for investors? Do we need to do it ourselves? You would want a broker involved in the middle for sure to do that. And so there are brokers that provide lead flow. We do get deals as well that we prepare. And when we sent those to investors, we would typically go through. We have a sheet that we prepare that shows all of the key details to say this is what it looks like to lend to this person. Here's the overall risk profile. Here's in a private lending, exit strategy is really important. But frankly, what lenders do is they usually look at it and say, what is the loan to value, we call it. So if you're financing 50% of the value of a property, not that high of a risk unless it's in a really small town or a really weird property. But if you're lending in Vancouver at 50% of the value, things would have to go really wrong for you to be underwater on that property. 65% is often a sweet spot. This is a comfort level zone for most lenders. Even when the market swings and whatnot and things get tighter, 65% is almost always a spot where you'll get financing at that level. 75% is higher and riskier. And so generally your rate of return as an investor, if you're comfortable with even taking that risk on, should accommodate that higher risk level that you're taking on. So something to think about. All right. I don't see any more questions in the chat. Hopefully, I've answered most of your questions today. We'll have another webinar coming up soon. I'll always look forward to doing these. I was excited to do this one. This is different than the ones that I've done before. I'm hoping you guys got some value out of it. What I'll do is I'll get our team to send out to everybody that registered for this, which would include all of you, a copy of some of the materials that I was showcasing today, so that you can start to use that. And feel free to reach out to us if you wanted to run through any of the information and see if there's anything in there, and we'll go from there. So I don't think that chat replies are in the video. I'm not 100% certain of that, but I don't think they're in there. Awesome. All right, everyone. Look forward to seeing many of you in the future. Thanks a lot. Bye now.